Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of financial markets, uncovering unique opportunities and risks. Today, we're putting a specific micro-cap stock under the microscope, one that's been lighting up our hard-to-borrow screener, TGHL. We're going to break down exactly what makes TGHL interesting from a short squeeze perspective, explore its current characteristics, and discuss what these high borrowing fees really mean for traders. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about TGHL. This is a micro-cap stock, meaning it has a relatively small market capitalization, which often makes these types of companies more volatile and less liquid. Looking at recent price action, TGHL has seen a 0.0% change today, over the last 5 days, and over the last 30 days. Now, you might be wondering why those numbers are flat. That's because the volume data for TGHL is currently showing 0 shares traded today, and a 30-day average volume of 0 shares. This translates to a relative volume of 0x average. This means that while its hard-to-borrow status is significant, actual trading activity is currently non-existent. What is cost to borrow and why it matters? So, what exactly does hard to borrow mean, and what is this cost to borrow we keep mentioning? Imagine you want to short a stock. To do that, you first need to borrow shares from someone else, typically a broker, and then sell them. Later, you hope to buy them back at a lower price and return them to the lender, profiting from the difference. But borrowing shares isn't free. Brokers charge a fee for the service, expressed as an annualized percentage, which is the cost to borrow, or CTB. When a stock becomes hard to borrow, it means there is high demand from short sellers, or a very limited supply of shares available to lend, or both. This scarcity drives the CTB fee sky high, sometimes well over 100% annually, as we're seeing with TGHL. These elevated fees can be a critical signal because they represent a significant overhead cost for short sellers, putting pressure on them to cover their positions if the stock price doesn't move in their favor quickly. Why the stock is hard to borrow right now? Now let's get specific with TGHL. Our screener flagged TGHL primarily because its annualized cost to borrow fee is an eye-popping 773.1%. Highlight number that is an extremely high fee to pay to hold a short position. While we don't have information on CTB momentum or the exact number of shares currently available to borrow, that 773.1% CTB alone is a massive hurdle for anyone shorting TGHL. The estimated float for TGHL is 12.7 million shares. A smaller float means fewer shares are actively traded, and if a significant portion of those are already shorted or unavailable to borrow, it can create a very tight supply situation. Our internal composite squeeze score for TGHL, which combines factors like CTB, float size, and technical setup, is currently 46.5 out of 100. This isn't the highest score we see, but the CTB is a major contributing factor, pushing it into noteworthy territory. Squeeze mechanics explained. So, how does this all tie into a potential short squeeze? A short squeeze happens when a stock's price starts to rise, often unexpectedly. This upward movement causes short sellers, who borrowed and sold shares, to face increasing losses on their positions. To cut their losses or meet margin calls, they are forced to cover their shorts, which means buying back the shares they initially sold. This buying activity further pushes the stock price up, creating a snowball effect as more short sellers are forced to cover. When a stock has a high cost to borrow like TGHL's 773.1%, the pressure intensifies. Short sellers are not only losing money on the stock's price movement but also incurring massive daily costs just to stay in the trade. A shrinking supply of borrowable shares further exacerbates this, making it difficult for new shorts to enter and existing shorts to manage their positions. However, it's crucial to understand, a high cost to borrow does not guarantee a squeeze. It can also simply mean that short sellers have very strong conviction that the company is overvalued or has fundamental issues, and they are willing to pay a premium to maintain their bearish bet. Dilution risk check. When evaluating a potential short squeeze candidate, dilution risk is a critical factor. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding. While it might bring in cash for the company, it effectively dilutes the ownership stake of existing shareholders and spreads the company's value across more shares. For a short squeeze, dilution can be a significant headwind, or even a complete showstopper. If new shares flood the market, it can offset any buying pressure from short covering, effectively negating the squeeze thesis. We checked for recent dilutive SEC filings like SMINUS1, SMINUS3s, or 424 BS for TGHL in the last 90 days, and we found no such filings. This is a positive sign, as it indicates there isn't an immediate threat of new shares entering the market from the company's side. We also found no recent reverse splits for TGHL in our look-back window. Once again, please remember. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given TGHL's current status, a microcap with an extremely high cost to borrow of 773.1% but zero trading volume, it presents a very unique scenario. The high CTB signals intense demand to short or extreme scarcity of shares, but without any trading, there's no price movement or direct pressure for shorts to cover right now. What you'd want to watch for if you're interested in TGHL from a squeeze perspective would be any significant increase in trading volume. Even a small amount of buying volume, if sustained, could, in theory, put significant pressure on short sellers who are already paying such an exorbitant fee. Keep an eye on any updates regarding the availability of shares to borrow, as a shrinking supply combined with future volume spikes could be a powerful catalyst. So, to wrap it up, TGHL is a fascinating example of a stock that appears on a hard-to-borrow screener due to an exceptionally high cost-to-borrow fee of 773.1%. While its microcap status and no immediate dilution risk are points of interest for squeeze enthusiasts, the current zero trading volume means that any potential squeeze catalysts are not actively playing out. It remains a speculative case, highlighted by its borrowing costs, but currently lacking the market activity typically associated with a light squeeze. Always remember that hard-to-borrow status is just one piece of the puzzle. If you found this deep dive into TGHL and short squeeze mechanics helpful, please hit that like button, subscribe for more content like this, and let us know in the comments below what other hard-to-borrow stocks you'd like us to analyze. Thanks for watching, and we'll see you in the next video.